Hello everyone, welcome to this lecture 5 of week 10 for our course Metrics and Analytics of Marketing. As we know that in this week we are discussing various metrics associated with sales force and channel management. So in the last class we discussed about various metrics associated with the supply chain. In today's session we will try to look into some of the metrics, especially 3 metrics associated with the stock keeping unit profitability. And these 3 metrics are namely Markdowns, GMROII and DPP. GMROII stands for Gross Margin Return on Inventory Investment and DPP stands for Direct Product Profitability. So basically these are metrics similar like the profitability metrics, but normally the profitability metrics is calculated at the organization level, but here we will try to look in from the perspectives of the stock keeping unit. So let us dive more into this 3 metrics. Profitability metrics for the retail products and categories are generally similar to the other measures of profitability such as unit and percentage margin that we have already discussed during our previous weeks. Certain refinements have been developed for the retailers and the distributors. Okay. So let's talk about these 3 metrics: Markdowns, GMROI, then DPP. So as I have already said this one, the full form of these 2 abbreviations GMROI and DPP. Okay. So let's try to find out what are the genesis of these metrics. So when it comes to the markdown, by monitoring the markdowns, the marketers can gain important insight into the SKU's profitability. In the subsequent slide, I will exactly define how markdown is calculated. When it comes to the GMROII, it can be a vital metric in determining whether sales rates justify the inventory positions. GMROII basically it calculates the gross margin on the inventory cost. What is the cost of keeping the inventory and what is the gross margin that I am deriving from these items. So that gives us a picture of cost benefit analysis. Then it comes to the DPP. It is theoretically a powerful measure of profit that has fallen out of favor because of its complexity. Theoretically it is easy to calculate, but when it comes to this one practice, it becomes the attribution becomes a problem. However, this particular metric can be revived in other forms such as activity based costing. So how can you assign the cost to the activities? So it is extremely difficult to assign the cost to the product sometimes. So if I can actually look into this matrix along with the activity based costing, then probably I will be able to get a holistic view of it. Gross margin return on inventory investment is calculated as the margin divided by the cost of inventory and is expressed as rate or in terms of percentage. When it comes to markdowns, these markdowns are calculated as a ratio of the discount to the original price charged, right. So what is the MRP of the product in the retail store, and is the retail store selling the product at the MRP or they are giving you a discount? If they are giving you a discount, the difference between the MRP and that particular, that discount becomes your markdown. So I have marked down the price from a set level to a given level. Then comes this DPP. So this DPP is a metric that adjusts the gross margin for other costs such as storage, handling and allowances paid by the suppliers. DPP also takes into consideration the allowances that you are getting. Let's say manufacturer are giving you some allowances. So that will also be taken into consideration when calculating this DPP. Now purpose of the SKU profitability metric. This SKU profitability metric helps us to assess the effectiveness and profitability of individual product and the category sales. Retailers and distributors have a great deal of choice regarding which products to stock and which to discontinue as they make room for a steady stream of new offerings. In last sessions we discussed about push marketing and pull marketing, and we understood that both the marketing tactics are important in various contexts. Especially if you are into a push, you are into a industry where the push marketing works better than the pull marketing. In that case, the retailers will have a higher say in the supply chain, right. So, by measuring the profitability of the individual stock keeping units, the managers develop the insight needed to optimize such product selections. So, I will keep only in many instances probably you have also seen that retailers are pushing the product from a particular brand, or that particular brand is made more visible in their display as compared to other brands. Other brands will only be shown to you if you proactively ask for the brand, otherwise the display will be for a particular brand. Why they are doing that? So, they are doing that because probably they can derive more profitability from that brand as compared to the brand where the visibility is less. Profitability metrics are also useful in the decisions regarding pricing, regarding the display and regarding the promotional campaigns. Now, let us look into the construction of the markdown metric. This metric quantifies the shop floor reduction in the price of a SKU. It can be expressed as a per unit basis or as a total for the SKU. It can also be calculated in dollar terms or as a percentage of the item's initial price. Now, if we calculate this markdown in dollar terms, it is similar like the difference between the initial price of the SKU minus the actual selling price. So, what was the price that is displayed in the SKU and what is the price at which the product was sold? That difference gives you the value for the markdown. Then in terms of percentage, markdown percentage divided by initial price of the SKU. So, that gives you the markdown value. Let's look at the construction of the second metric, that is the gross margin return on inventory investment. This metric quantifies the profitability of the products in relation to the inventory investment required to make them available. This is calculated by dividing the gross margin on product sales by the cost of relevant inventory. So, if I calculate it in terms of percentage, then on the numerator we will have gross margin on the product sales in a period divided by average inventory value at that particular period of time. So, as far as inferences from this matrix are considered, it gives you the profitability level for that particular product or for that particular brand. Next, we will move to this complex metric, which is theoretically simple to understand, but it is always prone to attribution problem, that is direct product profitability. Direct product profitability is grounded in a very simple concept, but it can be difficult to measure in practice. The calculation of DPP consists of multiple stages. The first stage is to determine the gross margin of the goods in question, right. So, this gross margin figure is then modified to take account of the other revenues associated with the product. Let us say first I will calculate the gross margin, then I can also see, because I am keeping this particular brand in my stock, that is why the manufacturer is also giving me some incentive. That incentive will also be taken into consideration when calculating this direct product profitability, right. So, this can be this kind of incentives can come in terms of, let us say, promotional rebates from the suppliers, or it can come in the form of payments from the financing companies that gain business on its sale. So, let us say credit card companies. So, they are giving you a rebate, they are giving you something because you are facilitating their usage of credit card. The adjusted gross margin is then reduced by the allocation of the direct product cost. So, it has three components. So, one is the gross margin, then other incentives associated with the product, and then the direct product cost. First two parameters will be plus and the last parameter will be minus. And direct product cost, these are the cost of bringing a product to the customers. They generally include the cost associated with the warehouse, the cost associated with the distribution, and the cost associated with the stores. So, if I consider that these three are the main cost associated with the product, then I will sum up the cost associated with these three components and then I have to minus it from the gross margin. Okay. So, direct product profitability represents a product's adjusted gross margin less its direct product cost. As noted earlier, the concept of DPP is quite simple. Difficulties can arise in calculating or estimating the relevant cost. The variations between the products in the levels of this relevant cost can be quite significant. So, in the grocery industry, the cost of warehousing and shelving frozen goods is far greater per unit or per dollar of sales than the cost of warehousing or shelving in canned goods. So, I mean the costing has to be different in different contexts, has to be different in different industries. So, if I have to ultimately derive a equation for direct product profitability, it is gross margin minus direct product cost. And gross margin is not the simple gross margin, it is the adjusted gross margin, because we are also adding the other incentive that is being derived because of selling the product, maybe in terms of rebates. So, let us look at the concept with an example. The apparel retailer wants to prove further into the profitability of its stock line. That one example that we have taken in the last class, right. So, I am just extending the same example. Toward that end, it assembles some of the information. For this retailer, stocks generate slotting allowances, in essence fees paid by the manufacturer to the retailer in compensation for shelf space, and that amount is, let us say, $50,000, right. Warehouse cost for the retailer come to, let us say, 10 million per year, and let us also assume that stocks consume 0.5% of the total warehouse space. Now, for this stocks I can attribute the cost. So, 0.5% multiplied by 10 million will give me the cost of the warehouse for the stocks. Estimated store and distribution cost associated with the stocks, let us say it is $80,000. And as we know, in the last example only we said that the gross margin for that particular year is $350,000, right. So, with this information the retailer calculates the adjusted gross margin for its stock line. What is the adjusted gross margin? Gross margin plus additional margin. So, what is the gross margin given here? It is $350,000, and additional margin that you are deriving, that you are getting either as a rebate or as an incentive from the manufacturer is 50,000. So, my adjusted gross margin will not be just $350,000, it will be 350,000 plus 50,000, that is $400,000. Now, let us also calculate the direct product cost. So, direct product cost can comes in the cost of store, cost of distribution and cost of warehouse. So, cost of store and distribution is given as 80,000 and warehouse cost can be calculated because the total warehouse cost is 10 million and the stocks constitute 0.5% of this warehouses. So, 0.5% multiplied by 10 million, that gives me $50,000. So, total direct product cost comes to 80,000 plus 50,000, that is $130,000. So, ultimately I can calculate the DPP, direct product profitability, that is adjusted gross margin minus direct product cost. 400,000 minus 130,000, that is 270,000. Fine. So, this is how I can calculate the profitability from a product line. Now, let us summarize this matrix: markdown, GMROII and DPP. Markdowns are not always applied to slow moving merchandise. Markdowns in excess of budget are almost always regarded as indicators of errors in the product assortment, pricing and promotion. Markdowns are always expressed, if not always, often expressed as a percentage of regular price. As a standalone metric, a markdown is difficult to interpret. So, that is why we will need more information, we have to get into more insights before interpreting the markdown. Otherwise, as a standalone metric, it cannot set the context. GMROII, so gross margin return on inventory investment, it is applies the concept of return on investment only to what is often the most crucial element of the retailer's working capital, and that is the inventory. Many retailers struggle because of the cost associated with the inventory. If they cannot sell the products on time, they struggle with their working capital. How do they procure the new items? How do they pay for the incoming items? So, that becomes a challenge, and GMROII is one of the indicator of that matrix. So, it helps you settle, it helps you plan your working capital. The DPP, direct product profitability, it shares many features with the activity based costing. Under this ABC, a wide range of costs are weighted and allocated to specific products through some of the cost drivers, the factors that cause the cost to be incurred. So, why this cost is, for example, I am a manufacturer of a bottling plant, water bottling, right, but still there will be an office, there will be a receptionist, there will be, so how do I allocate the cost associated with the salary of the receptionist? How do I allocate the cost associated with the salary of the manager? So, this cost drivers, I will first try to understand why the position of receptionist exists, and then indirectly I will try to allocate the cost to the products. In measuring the DPP, retailers factor such line items as storage, handling, manufacturers allowances, warranties and financing plans into calculations of earning on specific product sales. So, there will be a post purchase service team, there will be people who will be dealing with the warranties. So, all this cost needs to be somehow associated with the product. So, let us say there can be a, the warranty team will only be involved in very limited number of items, but still the cost has to be equivalently distributed to across the items, right. So, that is why it is theoretically easy, but practically difficult. Then comes the concept of shopping basket margin. So, the profit margin on an entire retail transaction, which may include a number of products. This aggregate transaction is termed as basket of the purchases that a consumer makes, right. Sometimes I am selling the product, there are some categories of products, some type of products which were being sold to the customers. The initial margin is not high, but the subsequent accessories, those will be required for uses of this product, they will have a higher margin. So, whenever we are calculating the margin or profitability, we do not just keep the profitability because of the main product. Rather, we try to take a holistic view of the profitability in terms of profit that can be derived from the accessories associated with the product. One key factor in the firm's profitability is that capability to sell ancillary products in addition to its central offering. In some of the businesses, more profit can be generated through the accessories than through the core product. So, let's take the example of beverage and snack sales at the movie theaters are prime example. So, whatever margin they are deriving from the movie ticket, they are also deriving a significant margin, if not more, from the snacks and beverages, right. Similarly, if I take the example of a printer, so the margin that the company is deriving from the printer may be lesser than the margin that they can derive from the cartridges, right. So, in extreme cases, the core, at some point of time, the core product can be sold without any profit, with an assumption, with an expectation that they will derive the profit from the accessories. With this in mind, marketers must understand each product's role within their firm's aggregate offering, be it vehicle to generate the customer traffic, or to increase the size of each customer's basket, or to maximize the earning on the item itself. So, sometimes some of the products are kept in your retail store, though you know that margin is not more, but you are keeping that particular product category, because otherwise the customers will not get the facility of the product assortment, and if they are not getting the facility of the product assortment, there is a fair possibility that they will switch to other outlets where they get the assortment. So, whenever we are calculating the profitability, we can calculate it from a holistic view rather than concentrating profitability just for one item. So, let us say for one item the profitability is not high, right. So, if we take a decision like let us drop this item, there is a fair probability that customers will come and demand for that particular product, because they are not concerned about your profitability. If they do not find that product in your store, in that case they will start purchasing even other product categories from the nearby outlets. So, unless and until you are able to provide with the proper product assortment, then you will lose the customers. Similarly, as I have already cited that sometimes the core product profitability is lesser, but the profitability from the accessories you can earn a lot, right. So, with this I will stop today's class. I will start with the week 11 in the next class, and thank you for attending today's sessions. I will see you in the next class.